Supply and demand is an important concept, and it's something that's very prevalent in our day-to-day lives. Supply and demand governs how we buy things, how we sell things, and really just how our economies at scale operate. Whether we relate this to buying groceries, buying video games, buying clothes, or even buying currencies, supply and demand is at the forefront of the decisions that are being made. So in short, supply and demand in economics is the relationship between the quantity of a commodity that producers wish to sell at a various price and the quantity that consumers wish to buy. It's the main model of price determination in economic theory, and again, it's very prevalent in our lives. The price of commodities are determined by the interaction of supply and demand within any market. Supply and demand are governed by two important components, price and quantity. And very simply put, as price increases, the demand for a particular commodity tends to decrease. And on the flip side, the supply for that commodity increases. And there's two reasons why it would increase. One being price is high. So when price is high, when you sell, you make more money. So you'll want to sell. And on the other end, since demand is low, supply just ends up being higher because there aren't any active or willing buyers to buy that supply. Now, on the flip side, if price begins to decrease, the demand for that product increases. And because the demand for that product increases, generally speaking, the supply for that product will be much more reduced, which tends to drive the price. When we see supply meeting demand, that's called fair value of price. And generally speaking, that is the acceptable value where a buyer and a seller match on what a good or service or commodity is worth. So for example, if someone is selling a TV for $100 and they found a buyer that's willing to buy that TV for $100, the seller values that $100 more than it values the TV in which it's selling. And the person willing to buy the TV for $100 values the TV more than the $100 that they're willing to give for that TV. That's fair value in price for both parties. And as a result, the TV is sold and both parties walk away happy. Now, if we just think about that in a different light, if the price was moved up to, say, $150, that buyer may not be willing to actually purchase that TV, which means there's a reduction in the overall demand for that TV at that price point. And we see that when we are grocery shopping, for instance, and certain things go on sale. People go crazy when certain things are on sale. They stockpile and generally speaking, buy up everything because the price is cheap. But when you factor in when price is so cheap, generally speaking, the supply is low. And what that ends up doing is it gets sold out very quickly. And we've seen that in grocery stores where something goes on sale and then these shelves are completely empty. We can also convey this with the recent trend in cryptocurrency mining and the relationship it has with graphics cards, computer graphics cards. Because crypto mining is such a hot item and a lot of people want to get involved in it, and they know it requires a high-end performance graphics card like the 3000 series NVIDIA cards, what we see in the marketplace is that the demand for those cards is incredibly high, but the supply of those graphics cards is minimal. So when you do actually find a card to buy, they end up being more expensive. You can also look at this for PS5s when they first came out. The supply was relatively low, but the demand was massive. So people that could get their hands on PS5s, a lot of them being scalpers, ended up selling them for atrocious prices because there was such a high demand. People were willing to pay well above the fair market value for that. The concept of supply and demand really does affect how we make decisions, and it's no different than a financial asset like a currency. Banks, institutions, and large hedge funds are operating under this entire framework of supply and demand. They're trying to buy currencies when they're cheap and sell them when they're expensive. They also know that if they're running a business and their inventory is actually holding currency and selling them for transactions, they will buy certain currencies when they are cheap, holding them for months, maybe even years, until that currency appreciates in value so that they can then turn and sell it. And banks do this all the time. Accounting departments do this to hedge their risk as well, but that gets into a little bit more of advanced supply and demand, because when you think about supply and demand, everybody has a reason for wanting to buy or sell something, and it's going to affect the price and the quantity that's both demanded and supplied and the interaction between supply and demand. But now you're probably wondering, how does this really factor into currency? Yes, I understand that institutions want to buy and they want to sell, and yes, that's going to drive price. But really, how does that translate to a price chart? And how can I actually take advantage of it? So what we're trying to do when looking at supply and demand trading is we're trying to identify when an institution or large pool of money is entering the markets. We're trying to identify their footprints and trade alongside them. Now, of course, like I said, they're trading for a completely different reason. We're simply trading based on the footprints that they're leaving in the markets. So it's our job to identify when high points of demand from these institutions is created or high points of supply is created. Basically looking for when they're buying and when they're selling. And we can see that on the charts. Institutions are just simply unable to hide their position sizing because their orders are so vast. They move the market. And more often than not, when they do enter the market, they're not able to enter all of their positions in one go, which is why you'll see price gravitate back to these particular supply and demand zones and then continue based on those, because they need to fill their orders. They might get 50, 75% of their order on the first entry, or maybe even 25% depending on liquidity and other concepts we'll discuss. But price has to return back to that area so that they can load up on their full size position. So let's take a look at the actual ways of identifying supply and demand on a price chart. So here we have two specific ways of creating a supply and demand zone. We have range created supply and demand, and we have pivot created supply and demand. The first thing to really understand is what a range is on a price chart. So a range on a price chart is simply a sideways correction or consolidation where you see price moving basically to the right side of the chart. It's not really moving in any direction up or down. It's moving sideways. It's very easily visible on any price chart. You'll know when price is consolidating and moving sideways. One thing to note is ranges can be found on all time frames, and sometimes you need to look up a time frame in order to see that you actually truly are in a range if you're too zoomed in. Ranges indicate one of two things. One being high volume order flow where many orders are changing hands and likely large players are beginning to stack orders at a fair value in price, which basically means that demand and supply are changing hands quite rapidly, but eventually you do see a large move to the upside or the downside depending on which side of the market is being traded. But again, it comes back to that concept of supply and demand. When there's fair value, orders are changing hands at a rapid pace and you're not seeing much movement on a price chart. When there is an imbalance in supply and demand, that's when you see price move rapidly in one direction because it's trying to seek more orders or liquidity to balance that supply and demand. Now, the other end of the spectrum of a range is also low volume in the market. And it gets a little bit confusing. I'm sure after me saying that, you go, well, how am I really going to know if it's high volume or low volume if ranges are both created by the same thing? And you'll see that. You'll see high volume tends to be a range, especially if it's at fair value. And low volume, if you see right as the New York session is closing and moving into the Asian session, price tends to range or consolidate, and that's because there's low volume at those market times. Or same thing throughout the entire Asian session compared to, say, London or New York session, the volume is inherently lower, therefore price tends to range more. So the volume dictates what's actually going to happen, but it can be confusing when price is stuck within that range because you're sitting there wondering, is it low volume or is it high volume? What do I do next? And the biggest thing to remember is we're not trading the initial reaction or the initial move out of that range. We are looking to catch the retest of that range if it truly is a supply or demand zone. The easiest way to determine which environment or volume you're dealing with is waiting to see what happens after that range is created. Does price rapidly move away from the range? Or does it just slowly trickle outside of the range? If it's rapidly moving away from that range, it's suggesting high volume, which implies that lots of orders have changed hands and that there was likely institutional backing, and we can use that as a footprint to potentially plan a trade. Now, on the flip side, if slow movement, if it trickles out of that range, it's suggesting low volume and more than likely not much has really happened. There just was simply not really any orders happening at that particular price level. A movement away from a range should be significant to clearly showcase momentum being injected into that market. We're trying to identify when large orders are being placed into the market, so we should see a rapid expansion away, whether it's up or down. If price moves out of that range and then immediately retraces, that's a further context of low volume. It might initially look like you have the willingness or an expansion out of that range, but if you don't see a whole lot of follow through and it just quickly comes back, generally speaking, that's a smaller injection of volatility, but generally speaking, not enough commitment to derive a supply or demand zone being created at that particular price point. So here we have an example of a range. And we can see quite clearly that price is trapped between a high and a low, and we're moving sideways to the right. Price is kind of contained between this high and this low. Now, if we consider the concept of supply and demand, we have premium pricing or supply, and we have discount pricing or demand. And then we have the equilibrium, which is the fair value pricing where supply and demand are being met. And what you'll see within these ranges, especially if you drop down to lower timeframes, there are a lot of moves back into the equilibrium point, as well as premium and discount. And basically what's happening between this range is a lot of orders are changing hands because there's a fair value at that point. Now, what we see when we are looking for a demand or supply zone that is created from a range, we're looking for that rapid expansion away out of that range, whether it's to the upside or the downside. So if we're looking at range created demand, what we see is a sideways range, and then we see a rapid expansion to the upside, and then a move back in to that overall demand zone. And what we would be interested in as traders looking at this footprint is the move back down into this demand zone, looking for our entry here. We don't trade the initial reaction out because we don't know which way it's going to move. We instead wait for price to return back to that demand zone to look for entries. The same can be said for range created supply. We see that sideways range. We see price expand out of that range to the downside, and then we see price return back into that range and then continue. And that's what we're looking for. Again, we don't trade the initial reaction out of the range. We're simply waiting for price to return to that supply zone to look for entries. Now, another way of identifying and mapping out supply and demand is looking at pivots created in the market. And generally speaking, what you'll see is a sharp move to the downside followed by a rapid expansion to the upside. That would create a pivot demand. And then you'd see, again, we're not anticipating catching the move to the upside, the initial move. We're waiting for price to return back into that demand zone to look for our entries. And we'll touch on all of that later. Just conceptually, this is how supply and demand zones are created. Now, if we flip over to the supply side on a pivot, we get a sharp move to the upside followed by a rapid expansion to the downside. Again, we're not trying to catch that expansion to the downside. What we are simply doing is marking out our supply zone and waiting for price to return back to that supply zone. What the range and the pivots are the footprints of institutions or the footprints of large orders being created in the markets. And we simply don't need to guess. We just wait for these footprints to develop, and then we wait for price to return to these areas. And we'll touch on entries on how we can frame up high probability entries using lower time frames, things like that. But at this point in time, it's really just about understanding the different ways that supply and demand zones are created. Now we understand the differences between how zones are created, whether it be range, supply or demand, or pivot, supply or demand. The next question you're probably wondering is, how do we actually map out these zones? I understand the concept between range and pivot, but when it comes to actually drawing them, I need to see candles. I need to understand how to actually draw these zones so I can patiently wait for price to return to these areas so that I can actually take trades. So what we have in front of us are a couple different ways of mapping supply and demand zones using these ideas and concepts of zone creation. If we start right here, we can see that we have that range created supply and range created demand. And we're using the range zone creation or marking the zone using the range that is created. So when we're looking at range created supply, for example, we have a sideways range in price. We can see that price is clearly moving sideways. And as a result, we're able to draw our supply zone using the highest high and lowest low that builds that range. In this example, it ends up being one candle that creates the entire range, but as we can see, price is more or less trapped within that range before it moves to the downside. And then what we do is patiently wait for price to return back to that supply zone to look for a sell entry. Now, generally speaking, when it comes to actually marking out your range, trying to focus on 4 to 6 candles at most is the best way to approach it. Anything more and your zones could get too large, too convoluted, and we want to eliminate as much ambiguity as we possibly can when we are creating our supply and demand zones. Generally speaking, if you have more than 8 candles, you can typically go up a time frame and refine from there. And what you'll see is on that higher time frame, you'll probably have that 4 to 6 candles, and on a lower time frame, you might be able to refine using some of these pivot concepts, which we'll touch in just a moment. So again, if we're looking at range created supply and we're mapping out our zone, we would mark out the highest high of that range in price and the lowest low of that range in price, and then wait for that expansion out of that range that would break the range in price that was created. And then we would mark out our zone, and we would patiently wait for price to return back to that zone to look for entry. And the same can be said for range created demand. We'd be looking for the highest high and the lowest low of that range in price. We'd be waiting for price to expand to the upside, breaking out of that range, and then we'd be patiently waiting for price to return back to that range to look for an overall trade idea. Now we can take that a step further and refine our supply and demand zones that are created by ranges by using a concept of pivot. And basically, we'll start with pivots first. So again, what is a pivot? A pivot for a supply zone creation would be a sharp move to the upside before a rapid expansion to the downside, or a sharp move to the downside before a rapid expansion to the upside. If we're going to be marking out our pivot supply zone, we would be using the pivot candle that created that sharp move to the upside and then followed that expansion to the downside. Or on the demand side of things, we would be marking out as the sharp move to the downside before that rapid move to the upside. And again, we would be marking it on the bullish candle before the bearish move, or the bearish candle before the bullish move. We can also take that a step further if there are multiple candles that create that overall pivot in price. And in this example, we have 2 bullish candles before the bearish expansion to the downside. So we would be able to mark out our zone using both of those bullish candles. And on the flip side for demand, we would use the 2 bearish candles to mark out our zone after we get a bullish expansion out of that pivot. So now that we understand the concept of pivots, we can then apply that to the range created supply and demand zones. And as we can see within this overall range that has been created, we have 2 bullish candles before the bearish move that expands to the downside, or 2 bearish candles before the bullish expansion that breaks out of that range. So we're able to refine our zone to using just the pivots if we wish. As well, if we go back to the first example, we could also use this last bullish candle before this bearish expansion to the downside, or this bearish candle before the bullish expansion out of this area. And this just explains and further adds to the level of refinement that you can have on range supply and demand, and how we can also just use the concept of pivots to build onto the idea of range supply and demand. Because we know with ranges, price is at a level of fair value and a lot of orders are changing hands. And what we know with pivots is the pivot is created by that last candle that creates that up move before the rapid expansion to the downside, or that candle that creates that sharp down move before the rapid expansion to the upside. So we're able to mark our zones using that candle as well. And what this showcases is the level of refinement that can be seen on a price chart. Because if we were to look on a lower time frame at this pivot, generally speaking, what we're more than likely going to see is some sort of range that creates that. But even if we just look at it conceptually, we see that we have that pivot in price. We have that pivot in price, and that's ultimately what's creating the zones. So when it comes to mapping out your supply and demand zones, you have a little bit of flexibility in terms of what you are looking for, and we'll build on that as we go through the rest of the concepts. But something to just keep in mind, that you have a little bit of refinement that you can use, or you can be a little bit more generalized when you see ranges. That is entirely up to you. It's entirely up to what you test and what makes the most sense to you throughout your testing and your understanding of supply and demand. Now that we have a solid understanding of what a supply and demand zone is and how to map it, the next logical step is to jump to the charts, run through some examples of simply just mapping out the supply and demand zones. Because one of the most important aspects of trading this approach is being able to effectively map and understand supply and demand zones, we're going to focus on actually drawing them and locating them on a price chart. Now, one thing I want to stress before we get into this particular video segment is I'm going to be focusing solely on mapping out supply and demand zones. I don't care necessarily at this point in time what happens to the right of the chart, if the zone is respected or if it's not respected or anything like that. Simply put, I am focusing on range created supply and demand zones and pivot supply and demand zones so that we can conceptually see how we map them on a chart. What we'll be doing in future videos as we navigate our way throughout the course content is we'll be building on this knowledge. We'll be able to identify zones that have a higher probability of working out. We'll also be able to look at how price returns to these zones, the inner workings between supply and demand, and how they relate to the overall order flow, and also how higher timeframes and lower timeframes work together so that we can build high probability trade ideas. But the first and most important part of understanding this strategy is simply being able to map supply and demand zones effectively. So what we'll do is we'll jump on a chart. Here we have US dollar yen, and I'm using a 15-minute chart just so that we can get a little bit more price action to build supply and demand zones. Again, I'm not really concerned about the result of the zone in question, but instead I'm going to be just mapping them out. So stay with me as we go through these because some of them conceptually won't do anything, but we're going to build onto that as we continue. So we'll start initially on the left side of the chart here. And as we can see, price is caught in a fairly large range, sideways price action. And as we can see, price is caught between a high and a low, and price really isn't moving outside of this large range. And then we finally see an expansion to the upside. Now, of course, like I said in the previous video, if the particular range is over anywhere from 6 to 8 candles, chances are that range is too large and is either going to be seen on a larger time frame or simply as a zone that maybe you shouldn't be focusing your attention on. And in this case, both are true. This would be a larger range or a range on a larger time frame, as well as something that we can navigate our way just to the right, and we can refine it to a more important piece of the overall chart. And what we can see is we do have a sideways correction in price. We have price that's trapped more or less within this range of price, and then we get an expansion to the upside. Basically what we've been able to do is take this entire range and simplify it to something a little bit smaller, something that's a little bit more conceptualized into a smaller amount of candles. Although again, if I just move my bar, we have about 18 bars. We're really only concerned about 6 to 8. And what we can do is we can just begin to look at the 6 to 8. And what we can see based on the expansion to the upside is we actually have a sharp move to the downside followed by that expansion. So while we do have a range, we also have that pivot in the market. So what we'd be able to do from a supply and demand zone perspective is draw out a pivot demand using this sharp move to the downside to draw our zone. If we wanted to look to refine that to just one candle where the momentum of that move really arrived at, we could actually move it to this bearish candle before this large expansion to the upside that broke this range. And we'd be able to mark that as our demand zone. I'm going to leave it as the entire pivot, as this is the move, this sharp move to the downside that created that expansion to the upside. And then we'll just keep moving forward from a price action perspective. So as we can see, price rapidly expands to the upside, and then we get a sideways bit of price action, or more specifically, we get a sharp move to the upside followed by an expansion, or in this case, we have a sharp move to the downside followed by a true expansion that actually breaks out of the larger range. So from that, we can build another demand zone, something just like this. And now we have a demand zone, and we can just keep moving on to this top section, and where we can see quite clearly that we have a sideways range in price, and then we have an expansion to the downside. So what we can view this as is a supply zone, and we can draw it with the lowest low of the range to the highest high. I wouldn't necessarily be including this wick in my supply zone for a couple of reasons. One, because it does extend the supply zone quite rapidly, and we're more interested in what's happened just before that move that expanded to the downside. But that being said, if we just do a really quick measurement of how much this zone really gets added onto, it's about roughly 2.5 pips. Is 2.5 pips really going to make or break your supply or demand zone? Not necessarily. So it's not a huge issue. And now if we just look at that, so we have this range in price, the expansion out of that range, we know it's a supply zone. What we can also see is that we actually get a sharp move to the upside followed by that expansion to the downside. So we can actually refine this particular supply zone to this candle, and now we have a pivot supply that we can be looking at. And then we can see that price expands to the downside and continues on. And then what we can see is as price interacts with this demand zone, we do get a reaction. The reaction is not successful and price does continue to break to the downside. And in future episodes, we'll explain why the likelihood of this demand zone holding was not overly high. But again, for now, we're going to primarily focus on just drawing out supply and demand zones so that we can just understand the inner workings behind the charts. So when we look at this, what we can see is, again, we have a range in price. We can see that price is caught between this high and this low. We're getting that price action, and then we get an expansion out of that zone. So what we can actually do is we can draw it from the lowest low to the highest high of that range, or more specifically, we could also just factor in this pivot in price as a pivot supply zone. So we had our range, just grab that. We have our range created supply. We have our pivot supply, or what we can do is we can actually refine it one step further and go to more of the candle that created the momentum on the overall pivot. So we have 3 different ways to map out this particular supply zone, all of which are valid, and ultimately depending on how big and wide you want your supply zone. So something like this is about 12 pips. If we move to the pivot in itself, it doesn't really make it that much smaller, which is about 11 and a half pips. And then if we go to that last candle, this is where you'll get a much smaller, tighter, and more refined zone of 4 pips. There are times when using a refined zone are more advantageous from a risk to reward perspective. And there's times when you need a larger zone, especially if you're looking at something that's a little bit more higher time frame and you're waiting for price to return in to that zone, and then you're looking at lower time frame order flow to actually get involved. Again, we'll go through all of that, but just to get your mind thinking about some of these things. And like I said, there are many times where we're seeing that these supply and demand zones are just not holding, where we'll be able to build up frameworks of why these particular zones are not holding and what this is implying to the overall strength of the move or the inner workings of the order flow that we're seeing here on the chart. So now if we just keep moving on, what we can see is once we move to the downside, price forms another range, or specifically we get that sharp move before an expansion to the upside. And then if we just keep moving forward, again, we have a range or a sharp move and expansion to the upside. So we have 2 range created demands or 2 pivot created demands, depending on how you would like to view it. So if we created our range created demand here, we could draw it from the lowest low to the highest high of the range. We could simply factor in our pivot, which would be more so focused on these 2 bearish candles. We can see that sharp move to the downside before the expansion up. Or finally, the one last way we could refine this particular pivot is on the last bearish candle that creates the momentum that actually pushes that expansion to the upside. So a couple different ways of mapping that. And then again, we can move up to this next range created demand zone, which we can do from the highest high to the lowest low of the range. That would be our range created demand. We can see that we have that sharp move to the downside followed by an expansion to the upside. So what we can do is we can just map out the 2 bearish candles. Now, if we have an instance where there's a lower wick on the next candle, I like to also include that, because what ends up happening is if you only draw your zone to this point, and what you'll learn in entries is we start to put our stop losses based on the way the zones are positioned. And if we have our stop loss sitting here, the chances of getting stopped out end up being a little bit more increased, and we want to make sure that we're including the entire range of a particular zone, so we kind of have the highest amount of understanding of where price was delivering at that particular point within the premium and discount of the supply and demand zone itself. So in that case, just using the bottom wick ends up being a little bit more beneficial. And again, it only adds about 1.5 pips to the overall zone in question. So it's not something that's going to make or break a trade or make or break anything that we're doing, especially in this particular episode. So we keep moving forward. What we can see is we have a sharp move to the upside. We also have a range in price followed by another expansion to the downside. So we can suggest, so what this suggests is that we have a supply zone. We have range created supply, which we could factor in this wick, the highest high to the lowest low. This is a very large zone. This is a very large zone, about 15 pips. So what we can actually do is focus more on the pivot, which we would take these bullish candles. And again, this wick exceeds the bullish candle, so factoring it in is just a good practice to have. And then finally, what we can actually do is we can focus on the last bullish candle before that large move to the downside to refine our supply zone a little bit further. And we'll just keep walking through price a little bit further. And what we can see is we get a move to the downside. We get a sharp move to the upside followed by another sharp move to the downside. So what we can actually do is view this as a pivot supply zone. And we'll keep continuing on once again. And what we can see is we have a range. We also have a sharp move to the downside delineated by one candle. Again, this would be more of a refinement on our demand zone. Then we get that expansion to the upside. And we could draw it from the lowest low to the highest high of the range, which would be something similar to that. Or we could draw something more like that, which would be based on the pivot candle in itself. And what we can see when we're just looking at these zones from a conceptual standpoint is that there are a lot of zones that simply don't really hold at all. You get a reaction, but no real follow through. You get a reaction, but no follow through. You get no reaction whatsoever. You get a reaction that's decent. You get a small reaction, no follow through, so on and so forth. And again, we'll touch on how to frame up higher probability supply and demand zones and understanding what this is ultimately suggesting from an order flow perspective, having supply being respected and demand breaking or vice versa. But conceptually, when we're trying to understand what is actually happening on a supply and demand basis, we'll focus on this zone right here, just because as we can see, we get a move away. We have a range in price, which is suggesting that from a fair value perspective, a lot of orders were being changed hands at this point, and at some stage selling created more of a movement, which is why we've seen that expansion away. And then as we can see, as price returned back to the range and back into the pivot, we had a reaction that caused a follow through. We came close, we had another follow through, and then we tapped into it a little bit deeper, and then we got another follow through, which continued to push a little bit further as we see. So what that means and what's that suggesting on a chart and why this is important to us is when we're looking at a range created supply zone, for instance, what's happening, as I said, is there are multiple orders changing hands in this particular range. There's fair value being met, and at some point the sellers overpower and price is moved heavily to the downside. And then at some stage price will move up and down, basically gravitating back to this supply zone, basically rebalancing the imbalance that was caused by this large move. But what this means is an institution or a series of large orders were placed to propel this move to the downside as rapidly as it was. But generally speaking, this would have been a smaller portion of a larger order. Institutions are generally speaking unable to position themselves fully in one go because their order sizes are just simply too big. This is basically why we see this large drop. And what they're hoping to do and what they're setting out to do is for price to return back to those price points so that they can then execute the remainder of their position and continue on their overall trend or trade direction that is being facilitated. Because again, we're having a bunch of volume being pumped into the market here. The full order is not there. This might be 25% of the actual volume that they're wanting to trade. This process right here is basically building liquidity and rebalancing the orders to push price back into this area because there is willing supply at this level. And then once price reaches this supply, this is where this is where 75% or the remaining 75% is pumped into the market, which just causes price to move to the downside yet again. And in a nutshell, this is what we're attempting to identify, and this is what we're attempting to create trades based off of. We are identifying the framework that institutions or large series of orders are being placed in the markets, and that's why we see ranges in price or sharp moves, pivots, that then create an expansion to the upside or the downside. The sharper the move, the more likelihood that a large order has been placed in the market. And that's why not all moves are said to be equal, in which we can see that this move is much bigger than this move here. And especially this is an actual full move of that zone, whereas this move is actually broken into two moves. And if we look at something like this, where this is a much larger move than, say, something like this, but at the same time, from a fractal perspective, and this is something we're going to speak a lot to, is the fractal nature of the markets, things that are happening on higher time frames and going down to the lower time frames. What happens on the lower time frames happens on the higher time frames. What happens on the higher time frames happens on the lower time frames. They're one and the same, but the picture has to be built from one time frame to the next. The argument to be made is whether things happen on the lower time frame first or the higher time frame first. They go hand in hand, but conceptually, when you think about it, things need to be built on the lower time frame because the lower time frames are what build the higher time frames. And if you can understand the fractal nature of what's going on within the order flow, you can begin to piece together the higher time frame picture. It takes a lot more volume and capital to move the market, especially when we're looking at higher time frame moves versus lower time frame moves. And this is, again, how we start to build trades. This is how we start to quantify certain supply and demand zones and begin to map them out accordingly. So again, we have our range created supply and demand and our pivot created supply and demand. We've been able to identify areas where we have range and pivot, and being able to refine from a full-on range or a full-on range here and move it down to a pivot, or be able to refine down to even simply one candle. We have a lot of different options in terms of how we're drawing zones, how we're refining zones, and we can keep running through this process as price goes on. And again, as you run through this example, and I highly recommend that you now hit the charts and you start to look at these demand zones and supply zones, both range created and pivot created supply and demand zones, map them out on your charts. Again, you'll probably have a lot of zones that are just intertwined within each other. You'll have a lot of zones that simply don't work. They don't get respected, anything like that. And by the end of the exercise, your chart's probably going to look incredibly messy. There's really no other way to put it. But what this exercise is going to do is it's going to get you thinking. It's going to get you comfortable with mapping out supply and demand zones. And what you'll begin to do is train your eyes to see supply and demand zones. And one thing that I recommend doing after you've completed this exercise of just simply mapping out supply and demand zones, again, don't worry about what happens to the supply and demand zones. Just worry about mapping them out and understanding the order flow and understanding what's actually happening from a candle to candle basis. Again, we're going to build on this so that we can start to eliminate certain supply and demand zones from what we're actually looking at, and also understand the fractal nature of price action and seeing a move like this, being able to capitalize on that short-term sell while also looking for buys on, say, a 1-minute chart, things like that. We're going to dig into all of these concepts, but the first and most important step is just getting comfortable drawing out the zones, drawing out the price action, drawing out the ranges, drawing out the pivots, understanding that interaction, looking at the different ways price moves out of these ranges. Do we get a full-on move? Do we get corrective moves where price is struggling to move up and down? Price is somewhat balanced. Do we get ranges being created? What is that suggesting? Are we in between two more outer supply and demand zones? And then what is this price action in the middle suggesting? Because if we look at this in the concept of supply and demand, we have our top range, our bottom range. We have an equilibrium point, and price is moving in a larger range. And again, we're on the 15-minute time frame. So if I were to move up, what we would see in this bit of price action is a range. And this explains what's going on in these smaller time frames, but now we're seeing the price action within it. And as we can see, when we look at the price action within it, we're looking at that equilibrium point or the fair value between supply and demand, we can see that price is gravitating towards this. And this is exactly what's happening here. And this is explaining the fractal nature of what we're trying to convey here. But again, I'm getting a little bit ahead of myself. I want to build the foundation slowly and I want to build it effectively. Now, what I want you to do after you finish this video is go straight to your charts and just open up a blank chart. It doesn't matter which currency, commodity, index, or whatever it is that you want to look at. Open up a chart, any time frame, and just start mapping out supply and demand zones. Now, of course, if you go to something like a lower time frame, like a 15-minute, a 5-minute, a 1-minute, you're going to have the opportunity of seeing a lot more supply and demand zones. There's going to be a lot more data and price action that you can study, but this is prevalent from the monthly all the way down to the 1-second chart, and you're going to see it. And really the process and the point of that exercise is to train your eyes to be able to see these very quickly and be able to, from that perspective, just map it out in your mind what's happening behind the scenes. Because again, we've been able to identify a apex demand zone and apex supply zone. We're seeing that price isn't really moving between it. And then we see that we have a larger range that's happening, say, on a 15-minute. So go to your charts, map out all of the supply and demand zones that you see using the references in the previous video. Have the infographic that I've created on another monitor or readily available that you can refer back to as you're navigating through the charts so that you're comfortable with mapping out these supply and demand zones, so that you're able to see them, you're able to understand what's happening, you're able to draw them, you're comfortable in drawing them, and you just get better at identifying them quickly and efficiently so that we can continue moving on and building on those pieces. Because it's incredibly important that you have a strong foundation of identifying these supply and demand zones, being able to draw them, being able to map them, being able to see them on a chart, being able to understand what's happening when ranges are created, seeing what's happening when you see pivots in the market, and being able to map them out efficiently and effectively so you can make decisions. Again, we're going to build on this sort of knowledge. We're going to be able to understand what these supply and demand zones mean, what happens when a supply zone is broken or when a demand zone is broken, what the significance of a return back to a zone may imply. All of these building blocks we're going to build on, but at this point, the main and primary focus you should be having is just getting comfortable mapping out supply and demand zones. Now that we know how to identify and map out supply and demand zones, whether it be range created supply or demand or pivot created supply and demand, now we can move on to the different types of these zones, whether they be continuation or reversal type models. So right here, what we have are continuation models for supply and demand. Now, building on to what we learned of the creation of zones in the first video, we're going to be looking at the continuation of demand and supply using ranges. Now, if we're looking at continuation patterns using these models, what we would see for a continuation demand model would be that you'd have an impulsive move to the upside. We'd be seeing a market moving to the upside. We would see that range being created, that sideways price action. We would then see price expand out of that range rapidly. And again, we're not trying to trade the break of that range, but instead we're waiting for price to return back into that range, that demand zone, to look for our entries. And on the flip side, if we're looking for range created supply of our continuation supply model, we'd be seeing price moving to the downside rapidly. We'd see that sideways correction. And again, we'd see it expand to the downside. Again, we're not looking to trade the initial break of that range, but instead we're waiting for price to return back to the supply zone, and that's where we'd be looking for our entry. Now we move on to pivot created demand and pivot created supply. Again, based on the first video, we have our pivot, which is a sharp move to the upside. And this can take shape of a few corrections as well within it, but generally speaking, the concepts are still that remain the same, where we have that sharp move to the downside, which is important, and then we get that rapid expansion away. Again, we're not looking to trade the initial expansion away from that pivot, but instead we're waiting for price to come back down into this demand zone and look for entries. Now, if we look at the pivot created supply, again, we have a sharp move to the upside. followed by an expansion to the downside. We're not looking to trade the break of that pivot, but instead waiting for price to return back to that supply zone to look for entry. Now, the reason these are continuation models is price was already moving to the upside before the pivot was created that created that demand zone, or price was already moving to the downside before it created that pivot that created the supply zone. We are basically just looking for price to be continuing in that direction, look for our footprint, and then wait for price to return to those zones. Now let's take a look at the reversal demand and supply models, again using the same zone creation model. So if we're looking at range created demand, we're looking for a move to the downside. We have that sideways range. Price then expands to the upside rapidly. Again, we're not looking to trade the break of that range. We're waiting for price to return back into that demand zone to look for entry in that newly created demand zone. Now, if we're looking at a reversal supply model using the range created supply, we'd be looking for price coming to the upsides, likely in an uptrend prior to that. We create a sideways range and then an expansion away to the downside of that range. Again, we're not looking to trade that initial break of the range, but instead we're waiting for price to move back into that newly created supply zone, that range, to look for our entries. And now we can look into the pivot created demand and supply reversal models. And similarly to the reversal demand model created by a range, we get that sharp move to the downside followed by an expansion away. The difference being with the range is we actually have that clear sideways range, whereas with the pivot, you almost get a double pivot where price creates a low, moves up, doesn't really go too much further. We move to the downside rapidly, create that pivot in price, and then price expands to the upside. This entire move is what formulates that demand zone. Again, we don't look to trade the break of that initial high. We're instead waiting for price to return to this newly created demand zone to look for entries. And then finally, we have our pivot created supply. And this, again, is created from an up move. We get a low that's created, then we have a sharp move to the upside and a break to the downside, a rapid move to the downside. Once again, we're not trading the initial break. We're waiting for price to return back to this newly created supply zone to look for entries. Now that we've gone through the models of supply and demand, whether they be the continuation or the reversal models, let's conceptualize this a little bit further and actually introduce the concept of candlesticks so that we can see a more clear and clean-cut example of what we would actually see on a price chart. So if we look at range created supply and demand, what we can see quite clearly is we have this sideways price action. For every down move, we get an up move, down move, up move. Price is contained within that overall range in price until we see a rapid move to the downside. Again, we're not looking to trade the break of that range, but instead we're waiting for price to return to this newly created supply zone to look for sell trades. And on the flip side, for the range created demand zone, we have this sideways price action. We see that rapid expansion away from this range, and we're waiting for price to return back into the demand zone to look for buy entries. Another way that you can draw range bound supply and demand, also using the concept of pivot supply and demand, and this is where the two can be interchangeable, is when you have that overall range in supply, what you can see is we have two up candles, and then we have this massive move to the downside. We can draw our supply zone using these two bullish candles before the large move to the downside, and that would build up our supply zone. And what we can see, if we just very quickly move this over, from a drawing perspective, the zone has not changed in size. It just becomes a little bit more specific to the up moves that see this large move in price. Coincidentally, alternatively as well, if we just look at this range created supply really quickly as well, using this idea, we can actually also draw our supply zone just on this first candle. So we have a few options, and it really comes down to personal preference on which way you prefer to draw your supply and demand zones, especially when they are range created. Sometimes the ranges that are created are simply too large to really work with, and this is where you have the flexibility to also put your attention to the last bullish candles before that move to the downside, or the last bullish candle before the move to the downside, depending. If we have 2 or 3 bullish candles before that large move, that implies a pivot. And if we have one, it's still a pivot, but it's a little bit more refined within the overall range in question. And the same is said with range demand. With a pivot zone creation, we have 2 bearish candles and then the rapid expansion outside of that range. Again, if I just move this over, the range would be exactly the same in this example, but it just refines it to a little bit more clean-cut way or approach of drawing or mapping the demand zone. Again, we can also use this one and just draw it on this last bearish candle before the rapid move to the upside, because again, in both situations, we are waiting for price to come back down into this newly created demand zone to look for entries. Again, this ultimately comes down to personal preference on how you want to map your candles, especially when you see range bound or range created supply and demand zones. Essentially what you can do is wait for that range to be created, map out the entire range, look for price to move to the downside or the upside, and then simply wait for price to return to that entire range to look for an entry. That gives you more flexibility in terms of where price will return to look for an entry. Whereas you can also simply mark just the bullish candle before that bearish move or bearish candle before that bullish move. Or if you have 2 bullish candles before that bearish move, you can use those, or 2 bearish candles before the bullish move. A little bit of flexibility, but again, it ties back to what makes the most sense for you and can be situationally dependent on if you have a very large range and conceptually the pivot or singular candle makes more sense to mark, then that ideally is the best route to go. Now, what we can also do is look at the pivot supply, pivot demands. And again, this factors into what we were just speaking about, where you have single candle creation and multiple candle creation of these supply and demand zones. If we're using pivot supply with a single candle creation, basically we have that bullish candle before the bearish expansion outside of that pivot. If it was a continuation pattern, we would have something like this, where we have that down move, the sharp move to the upside, and then the sharp move to the downside. So it's conceptually the exact same as what we had just spoken about. And what we would see within this candle as well, just to drive the point home a little bit more, is this single candle on a lower time frame, more specifically, is likely a range as well. And this is why you're able to factor in a single candle on a range as your supply zone in this case, or a series of candles within that, because this in itself is a pivot and this in itself is a range. So they are interchangeable, and that's why you do have the flexibility. Again, this is where it really comes down to testing them on the chart, seeing which really resonate with you. For some, ranges will just be the way to go. For others, it will be simply looking at single candles, because also what you can do, if you prefer, is drawing your supply zone using just one candle instead of the succession. There are just multiple ways of drawing out supply and demand zones using these creation methods, and it really comes down to testing, experience, and really just getting comfortable with the premise of supply and demand and what is ultimately happening on the charts, because price is fractal, and what you'll see on a lower time frame can also be included in just one candle, and we'll expand on that a little bit later on. But again, when we're coming back to pivot supply and demand, we have the single candle, which if we're looking at a reversal model would be something like this. There's your pivot, would be that right there. Or if we had a continuation, there's your pivot, and we're just drawing it on that singular candle. And the same can be said for the multiple candle creation, where we have something like that, where we have this pivot in price, or if we have a reversal, we have that pivot in price. Regardless of how you're looking at it, all the models remain the same in what we're looking to do. We see it being created, and it's our job to map out the zone in which way that we feel is the most high probability for our trading style. So regardless if we're trading range-bound created supply and demand or pivot, we have the opportunity of drawing our supply zone using the entire range. We can use the bullish candle, we can use the series of bullish candles, and on the flip side for demand, we can use the bearish candle, we can use the entire range, or we can use the series of bearish candles. And what we're doing is, now that we've established that price has rapidly moved to the downside or price has rapidly moved to the upside, we've been able to identify that a supply zone or a demand zone has been created. We just simply are waiting for price to return back to that supply zone. So we have that flexibility in understanding where price could go. Will it return to the entire range and fill to the upside, or will it focus on just this candle? We don't necessarily know where it's going to go. The only way we can truly know is if we do enough testing, get a large enough data size, and figure out probabilistically which tends to be more effective, especially for your trading style. Now let's refer back to our original example that we were using in video number 1. And instead of just focusing on mapping zones, let's break down which model of the supply and demand zones that we've mapped out, whether it be continuation or reversal and so on and so forth. So what we'll do is we'll start on the left side and just work our way to the right based on the zones that we mapped in the prior video. And what we can see if we just zoom out just a little bit more is we had that original range that we mapped out in the first video, and then we were able to refine it to more of this range, and then finally this actual pivot, which is where and what we based our zone, our demand zone off of. And what we can see is price is moving to the upside, and from that sort of information, what we can see is that this would be more of a continuation. What we can see is price has been moving in an uptrend. We're seeing that expansion to the upside, and then we see price create a sideways range and then expand to the upside, breaking out of that range to the upside, which is the basis of our range created demand zone continuation model. Also, what we can see is we had that price expanding to the upside. We had price move a little bit sideways, but if we just more or less disregard this information, we can see that price moves sharply to the downside and then expands to the upside. And we can even see that more fractally, that we have this sharp move to the upside and then an expansion, which is part of the larger range. This is the smaller range, and then this is the smaller pivot within that. So either way we look at it, we know that we have range created demand and we have pivot created demand. We can also see that we've come from an uptrend, we've created that range or that pivot, and we've continued to the upside. Therefore, this is a continuation model. And then if we just continue, this one's a little bit easier to explain and really just to see. Again, we have a range, we have an expansion to the upside, a range in price, or a pivot, and then an expansion to the upsides, another continuation model to the upside. Now, what we can see is as we continue, we have a move to the upside, we have a sideways correction or a range, and then an expansion to the downside. Or more specifically, we have a move to the upside, pull back down, another sharp move to the upside, and then an expansion to the downside. So this would be our reversal supply zone that is coming into play right here. As we can see, we came from an uptrend, we ranged, and then we moved back to the downside, and then we'd be looking for price to return back to the zone. Now, if we continue on, once again, we have another range that came from a down move or a pivot and then creates an expansion to the downside. So either way, if that we look at it, we can see that this is also a continuation model. Now, if we look at this demand zone, we can see that price ranged. We came from a down move, or we pivoted, and then we moved or expanded to the upside. So what we can see from this is a reversal model within the framework of a demand zone creation. The next one, as we can see, we create a sideways correction. We come from an up move and we range or create a pivot and expand to the upside. So we have a continuation model of demand. And we see that we range or create a pivot coming from an up move, and then we move back to the downside. So this is a reversal model supply zone creation. And what we can see here, we get an expansion to the downside. We have a pivot to the upside and then an expansion to the downside. So this supply zone would be a continuation supply zone. Now, if we look at this point, we have an expansion to the downside. We do get a reversal and we see price expand to the upside. We range and then move to the upside. So this in itself, this demand zone is a continuation model. Now, if we were to look fractally in this wick, and it's something that we'll expand on in a later video, we would see a reversal demand zone being created at this point in time. But as right now, and as we only stay on the 15-minute expanding on the initial video's examples, but what we could do if we just want to expand on this and touch on this just a little bit, we have a sharp move to the downside, especially in this wick, and then we get that push up. So we could use this as a pivot demand zone. And what we can also frame is this candle right here is a range on a lower time frame. So we do have that range created demand being met. And what we can see is price expands out and then we range once more and create that continuation model. And what we'll do, well, once again, just keep continuing on just to drive the point home a little bit further. Again, what we have is we have a large range in price. I know what we said in the previous video that if we have a large range like this, chances are if we go up a time frame, this would be a tighter range, or more specifically, it's an area that we shouldn't focus on too much or look to refine in other ways. And what we can see is we do get that sharp move to the upside, this pivot, and then an expansion to the downside. And as we can see, if we just draw it quite easily, we have come from an up move and then we've come back to the downside. So this is a reversal model. And then if we just continue on, what we can see is we create a range down here, much smaller, as it's only seen on a couple candles. We have a reversal demand zone being created. We have right here with this singular candle. I'm getting a little bit more in depth in the fractal nature. Again, we're going to build on this, but just kind of showcasing some of the things that we can be looking at, and without focusing too much on what happens on the right side of the chart in this particular video, but also showcasing a little bit what happens on the right side of the chart, just to get your mind thinking about these things. If you've often looked at a price chart and seen price return back to what unseemingly looks like one random candle, we can start to expand on that, and we will expand on that quite deeply as we continue on throughout the course. What we can see is we have this continuation model. As we've came from the downside, we've ranged and came to the upside. So we have our reversal demand, we expand to the upside, we pivot, and then we continue to the upside. So we have our continuation model here. And then if we look at this continuation, we retest into that, we've tested into this. And what we can see here is if we're just looking at this, we do have a very large pivot, which again is coming from an up move and then creating a down move. So this would be a reversal. But what we can see is we've been able to more or less refine it to this move, because as we see, we get this move to the downside, we get a pivot, and then we break structure. And if we're just looking at supply and demand, and again, we'll go into this in a little bit further, but the interaction between supply and demand, what we can see is when we create this large move to the upside that taps into this supply, we do in fact create a demand zone, or more specifically a larger demand zone, but this reaction is not incredibly large. I think we can all admit to that. We get a nice solid bullish candle, price expands to the upside, but we don't get any follow through. But what we can see is price does begin to react to that demand zone and begins to fall through and creates a downtrend. But again, just touching on that initial comment that I made in the first video, is we do and will see reactions to almost every single supply and demand zone that are printed on the chart. But it's our job as traders to build a probability model for each of these supply and demand zones, adding on to all of the demand and supply zones that are around it, what price is reacting to, and then looking at that particular supply or demand zone and asking yourself, would this demand or supply zone hold given all of the other information that surrounds it? Not only that on that singular time frame, but then also looking at your multi-time frame, understanding what the overall trend and things like that are. Again, we're going to build up on to all of this, but I bring this up more or less just to get your mind thinking as we continue to build on. We started out with how we actually map out supply and demand zones, and here we are adding on to the actual different types of models, whether it be continuation or reversal. That way you can start to frame up trades if you're looking to either scale into a already existing trend using a continuation trade, or looking to take more of a reversal once we get into a potential point of interest. And this is how we build up trade ideas. And then also finally, just adding on to a piece, the interaction between supply and demand, the fact that we're always going to see reactions to zones, and it's our job as traders to figure out if that reaction is worth trading or not. But as we can see, we have, in this case, a continuation model. If we were to use more of this larger supply candle, this pivot, we would have a reversal model. So we have a model within a model. That being said, of course, when we're looking at this time frame, this is an incredibly large zone for such a small reaction. So it's better to begin thinking about the continuation aspect. And that's why it's important to understand how continuation and reversal models work and how they interact with what is happening on a price chart. And then finally, we'll just wrap it up in these last few models. What we can see is price created this larger range in price. We came from an uptrend and then we've expanded to the downside. So what we can say from that is this entire range is a reversal pattern. But if we take it a little bit further, and especially if we were to drop onto a lower time frame, we can see that price moves to the downside. We pivot up and then we expand. So we can also view this as a continuation model. And what you'll see, and as we stress the fractal nature of the markets, is initially we would derive this as a reversal model, but then within it, we could also derive it as a continuation model, because especially as we're creating ranges, we can get price action that looks something like this. And again, what I said in the mapping video is we can draw our entire supply zone based off of the range that is created, or we can refine it to the pivot. And then if we just look at price action here, what do we have? We have a down move, we have a pivot, and then we have a down move. So if we just take what we know about continuation and reversal patterns, if I just continue this on, if we look at the range in itself, this is a reversal model. But if we're just factoring in this bit of price action, this pivot, then this is a continuation model within it. So we're building on to the overall framework of what is happening with order flow. Yes, the whole picture is a reversal, and then we're starting to see price continue into that move. And then if we look at this point, we have, again, a larger range, or more specifically, a sharp pivot. More specifically, again, this pivot right here. Of course, if we navigate it up to a higher time frame, we might see something a little bit more aggressive. Then we can see that we have a more continuation styled supply zone. And then we move back down in, and what we can see is in this small candle, again, touching on the fractal nature, we have a move to the upside, a pivot, and then a move to the upside. So we have a continuation model. We have a larger pivot coming from an uptrend, and then another expansion to the upside, a continuation model. So that's a really quick run through on the continuation models. Again, the main things that you're looking for are an expansion to the downside followed by either a range or a pivot, and that would create our continuation models. Or on the flip side, we'd be looking for price to move to the upside, range, and then move to the upsides, or price to move to the upside, pivot, and then move to the upside. These would be our continuation models that we would be looking for. And then on the flip side, looking for reversals, we'd have a move to the upside, a range, and then a move to the downside, or a move to the upside, some sort of pivot, and then a move to the downside, or a move to the downside, a range, a move to the upside, move to the downside, a pivot, and then a move to the upside for our reversal models. Now, what you'll need to do next, and what I strongly encourage and recommend now that we've gone through some examples here, to take this application and apply it to your own charts. A good thing to do is apply the understanding that you've gained from these videos into the examples that you created in your first assessment that you took place in when you were just simply mapping out the zones. Start to take the time to identify, is it a continuation or is it a reversal model, and map out all of that. Take a blank chart, maybe do it again, and just get really comfortable with, one, understanding how to map the zones, and then two, understanding what each of these zones is representing, whether it be continuation or reversal. And as we go, what we will be expanding on is how to identify a trend on a higher time frame, mark out higher time frame supply and demand zones, and then use the lower time frames to either scale into trades using continuation plays, or looking for reversal models when price is correcting and things like that. We're going to really build on that sort of information, but initially the most important thing is understanding how to map zones, and now the difference between the continuation and the reversal models. One other thing that I will add, and you'll probably see it through your testing, is the higher probability models are always going to be the reversal models. And when you think about it from a logical sense, we're looking at value areas that large orders, which are usually derived from institutions entering the markets, are being executed. And as a result, they're going to want to sell when price is high and buy when price is low. Generally speaking, some of the volume that gets injected on continuation patterns, they are effective, but in a lot of cases, they're more liquidity building aspects. I know we haven't explained what liquidity is, and we will dig into that in a lot of detail in future videos. But again, just to get you thinking. But what I'm getting at when I explain what I just said was basically that the higher probability models that are more than likely to play out are the reversal models, and the continuation models are a little bit less likely to play out. Now, with that said, of course, continuation models are going to play out, but what your mind should be thinking of is, if I know that the reversal models have a higher probability of playing out over the long term, and the continuation models are a little bit less likely to play out, you need to start to build trade ideas that base around reversal and then the initial continuation. Because as you get further up in an up move or further down in a down move, the more continuation models that play, the less likely that they are actually going to play out from a trade standpoint. So when you go through mapping out continuation and reversal models, just be mindful of each of the models and what ends up happening on the right side of the charts. Now, of course, don't fixate too much on the result of the zone. Again, like the first video, the emphasis is on just getting comfortable with mapping out the zones and then identifying whether they are continuation or reversal models. Now that we understand how supply and demand zones are created, how we map them, and the different ways that we can map them, the next most important thing is to understand how price is returning to the zone that we are looking to trade and what that may imply for our trade in question. Because as I stated in the previous videos, our job is to identify a supply or demand zone being created, map out that zone, and then patiently wait for price to return to that zone. Now the next step is seeing how does price actually return to that zone and what does that mean to me? So there's three different ways that price is going to return to a potential supply or demand zone. We have a rounded return, a corrective return, or a V reversal return. And each one of them has their pros and their cons, and we'll go through those right now. Again, we're looking at it from the lens of range created supply and demand and pivot created supply and demand. But as we spoke about in the previous section, was even if it is range created supply or demand, we can also map out our supply and demand zone using the pivot theory or refining to a bullish candle before that down move or bearish candle before that up move. So when we're looking at that and we're just focusing on range created supply and demand, however you map the supply zone in question is up to you at this point, but now we're focusing on how does price return. If we're looking at the rounded return, what we end up seeing is price very slowly rounding out into that supply zone. And more often than not, what we see is liquidity being built on the downside and on the slope or return back in. Now we'll touch on liquidity in a later section, but just keep that in mind for as we progress to the next sections. We can see that again in the demand section where we have this rounded return where price slowly rounds back into the demand zone. When you're looking at it from an order flow perspective, basically what is happening is there isn't a lot of demand at these particular levels or supply at these particular levels to push price. So basically what's happening after we've had that rapid expansion to the downside for a supply zone, there isn't any more supply to push price further down. And what needs to happen is demand needs to step into the market. But at this particular price point, there's a little bit of confusion in the market and price is filling orders, rebalancing the imbalance between supply and demand. And once demand has caught up with the amount of supply that's just entered the market, price then slowly rounds back into that supply zone, which is where we would look for our entry. The same thing can be said about demand. There was a rapid injection of demand into the market that pushed price higher, and price is now rebalancing the mix between supply and demand, and prices slowly and rounding back into the demand zone, and we would be looking for entry. This is a very high probability that the zone will hold, and this is a really great way to measure your return back into a supply or demand zone, looking for that rounded return. The next one that we would be interested in is the corrective return, and that's basically once price creates a supply zone, we see that expansion out. We're waiting for price to return back to our supply zone. You see price is moving to the upside, moving to the downside, moving to the upside, and it's conceptually it looks like it's struggling to move up and down, but we are slowly moving to the upside and back into this supply zone. You can see we create a high, we break that high, but then we're immediately moving back to the downside. And if we're looking at it from a basis of supply and demand on a more fractal level, once we create this up move, we create a demand zone, price taps into that demand zone, price moves to the upside, creates a new demand zone, we tap back in, we create a new demand zone once price moves to the upside, price returns back to that demand zone. And by that point, all of this demand has been consumed so that price can freely move to the downside. And what we can see on the flip side for demand is as price falls, we create a supply zone. Price taps into that supply zone, moves back to the downside. We create another supply zone. Price moves back into that supply zone, moves back to the downside, creates another supply zone that is tapped into again. All of the supply is absorbed so that price can freely move to the upside. And what we can see conceptually as well for the rounded return, just going back to that, touching on that, we don't really see that absorption of supply or absorption of demand as it returns back to the level. But the fact that it's rounding instead of correcting really is showcasing that there isn't a whole lot of, in this case, supply being created. So there's not really much existing here that we'd be looking at. If we're looking at support and resistance type traders, they would be looking for some sort of bounce at these levels, which is why price would be magnetized to move to the downside or move to the upside for demand. Now, if we move to the final return back to the zone, we have a V reversal type return. And this is basically where price creates a supply zone. We break to the downside and price basically immediately reverses back into it. We create that V price action. These are a very risky play in terms of trying to trade the sell on the supply zone. What this is implying is price moved to the downside rapidly. It was met with a fair amount of demand that pushed price up extremely rapidly. And basically what that means is it just shows a very strong reversal in price. More often than not, what that's going to imply is that price is not going to hold that supply level. What you may see is price move to the downside and then begin to move back up into the upside. And then the cycle would begin where you might actually be interested in looking for demand zones that were created on this V-type reversal. And it's the same premise and concept for demand zones. We get that aggressive move back in, basically it creates a V in price. It absorbs all of the demand there. But what we'd be looking for more than likely is a supply zone to be created for price to move to the downside. It's not to say that the V returns don't work, but statistically comparing them against these two, these are much higher probability because it's building liquidity or reason for price to continue, whereas this shows a change in order flow from supply to potentially demand. Because as you can see, just looking at these conceptually, you get this slow creeping move back in, slow creeping move back in. This one is a very rapid return back into that supply zone, which shows that there is not really an imbalance in supply and demand favoring supply. This is showing that supply and demand are very much balanced at this point, and it's better to wait for some sort of other criteria to look for a trade if you're looking at it in that respect. And the same can be said for pivot supply and pivot demand, where we have our zones created via a pivot, and we're looking for, again, that rounded return back into that supply zone or that rounded return back into the demand zone. These will always be, in my opinion, your highest probability setups, as well as the corrective return into a pivot supply or pivot demand. And then again, we have the pivot V reversal return, which is aggressive. We see basically that very quick reversal back into the supply zone. Generally speaking, these models don't tend to work out this return, and if you do tend to find this, it's better to stay out of the trade and look for something a little bit differently. Or if you do get some sort of reaction that does follow through, you might be able to trade a newly created pivot that has maybe a better return into it, a rounded return or a corrective return. And one final thing that I wanted to touch on in regards to return to zone considerations, what you'll often see on the zones that play out the most, and this may sound a little bit confusing initially because I had just said that the V reversal or that aggressive move back into a supply or demand zone tends to be lower probability, is if we're looking at, say, rounded return or corrective return, if that last leg into the supply or demand zone is relatively impulsive, we see a move that almost puts you off. So a larger move into supply or a larger move into demand. Often what that ends up being is an even higher probability that the move is going to be more aggressive to the downside. And it's really just on that last leg. Now, if the whole move is aggressive in, it's not great and it's low probability. But if that last little re-entry into the zone is high momentum or larger volatility candles, that often means that price is gearing up for a large move to the downside. What can be said is that there's a lot of momentum being pumped into the markets to get ready to push it down further. Just one final consideration to be thinking about when you're having that return to zone considerations is focus on your rounded and your corrective return to zones. And be mindful that the V reversals tend to be aggressive and don't play out statistically. Again, you can look to trade them, but be more cautious. And then also consider that last leg that's into a supplier demand zone ends up being what this would be called as a sucker's rally into it. This entices buyers to continue up and look to, in theory, break this range. But because we're entering a supply zone, we'd be pushing down, and that's why we get such a large, momentous move to the downside. The same is said where we get this sucker's rally to the downside. A lot of people look to jump in because what they see on their chart when they're looking, they just see price moving higher highs and higher lows. And they're just looking for this to be a higher high and price to continue moving to the upside. Or in this case, we're seeing lower lows and lower highs. So when we put in this lowest low, we're looking to see price continue to the downside. So this large injection into the zone is what propels the momentum faster and harder to the downside. And that pretty much sums up the return to zone considerations. It's definitely something to be very mindful of because, as I've stressed in the previous videos, is that we are waiting for price to return to these zones, and how it returns to that zone is incredibly important. So it's important how the zone is created and how you're looking to map that zone, but it's even more important to consider how is price actually returning to the zone that I'm looking to enter on. When you're able to frame that up, understand how it's returning to that zone, you can build and frame up very high probability trades, or even avoid trades that are inherently lower probability because of how they enter that zone. Now let's jump into some examples. And again, we're going to use the same example we've been using for the past 2 videos here on US dollar, Japanese yen, just building on the zones that we've already mapped out and really just going through the way price action is returning back to the zones just to further explain what we've just been building on. So what we'll do is we'll start on this very first demand zone, this range created demand zone, or the pivot created demand zone. As we can see, we had that large move to the upside, and if we don't worry about too much about all the zones that were created as this zone was coming back into it, what we can see is price was very corrective as it made its way back. And touching on what I spoke about in the end of the previous video, the theory behind the return to zone, we have this more impulsive move into the zone. As well as here, as we can see, we have 2 impulsive drives into the zone, but leading up to the zone itself was quite corrective. And what we can see is, even if we look at this point in time where price was about to tap into it, we can see that we had fairly corrective moves back into the zone. We didn't actually tap into the zone, and then we were seen with quite a bit of momentum pushing to the upside, which shows that this zone was fairly powerful. But definitely what we can see from the reaction and when we move the chart to the right, although we're not really focusing on what's actually happening as a result of these zones, just to add on to that, you can see that price tapped into the vicinity of the demand zone, and then once we actually tapped into it, it didn't quite move as far as we had expected. But now what we can do is we'll move on to this next demand zone, this range created demand, or specifically the pivot demand that we were looking at. We had that large move to the upside, and then what we can see is price just immediately came right back down. So we had the expansion up and an expansion down back into the zone. And what I said in the previous videos is, more often than not, we do get a reaction for basically every supply and demand zone that we see on a chart, whether the reaction is on the time frame that we are currently on, or if it's on just, say, a lower time frame. There's, generally speaking, always some sort of reaction. But at the end of the day, what we're most concerned about is the follow through of that zone. That's where we're actually going to be able to take successful trades, because it goes without saying, if we were to have entered long within this demand zone, initially we would have had a small amount of profit, but the end result of the trade would have been a loss or a break even, depending on how you manage it. So it goes without saying that we're more concerned about the follow through when it comes to supply and demand zones. And we want to build the highest probability and the highest cases for entries. And we know that generally speaking, when we have these V-shaped returns, it's an aggressive reversal from a creation of a zone. And generally speaking, the odds of that zone playing out or following through become to be a little bit more diminished. So we'll move on. And as we see, we create this supply zone, which we'll talk about now, where we get a more corrective move back into it, and then we tap into the zone and then continue on to the downside. And what we can see is we had a fairly aggressive move into the zone, which gave us that more confirmed and larger push away. You can see that we had a decent wave out of the supply zone in question. We did get this small push too, and if we see that we did have a somewhat large move into it and we had an aggressive push away from the supply zone. Now what we can see, if we just looked at the return from the left side of the chart, we can see that this is more of a V-shaped reversal. We had a little bit of correction, move back in, but I think we can all agree that this was a pretty rapid expansion back into the zone. And what we can see is when we continue down, we also had this supply zone, this range created supply or pivot supply that we've been able to refine to one candle. When we look at the return to that, we have a V return, and what we can see is price just blows right through it. Leading into that zone, we had this range created demand, which we've been able to refine to a pivot created demand, as well as this range created demand that, again, we've refined to pivot created demand. If we look at the return to this zone, we had a fairly aggressive V-shaped return. And as we can see that this is basically just one large move to the downside. And as well as this demand zone, we can see that this was an aggressive V-shaped return. We did get an initial reaction, but again, we just moved to the downside as a result of that. So we move on to the next supply zone. We can see that this supply zone that was created, we had a V-shaped return back to that supply zone, as well as this supply zone was more of a V-shaped return as well. A little bit more interesting since we had the range created demand that happened just before it really tapped into it, because as we can see, we had a reaction to the supply zone, but then price continued on to the upside. So on a lower time frame, this may have been a setup, and this is why you can identify reactions to supply and demand zones. But if we look at the reaction that really happened, we ended up moving more aggressively to the upside rather than the downside. So from that, conceptually, not a strong zone. Then we'll carry on to this zone, which we can very clearly see just looking at it. We had a very aggressive move back into the zone, a V return. And we'll just keep moving to the right side of the chart. This is an interesting one right here. As we had initially mentioned that this was a range created supply zone that we were able to refine to more of a pivot created supply zone. As we came down, we can see more fractally, we had a pivot here, and that's what we drew our supply zone based on. And what we can see is price sort of moved aggressively away initially, and then we started to consolidate. We created this range. And not going too much into session times, but this does fall within a lower volume sort of period. This would be the Asian session. So a lot less volume. And again, this goes back to what ranges imply high momentum, fair value, lots of orders changing hands, or low volume. And what we can see is, yes, in this case, we did get a decent move out. We can argue that these are some larger candles coming out pre-London session and at the London Open. But the follow through wasn't exactly ideal, but I'm getting ahead of myself when I touch on some of those topics. But just to explain this a little further on, we had a range, this corrective departure from the zone, and then it ended up being more of a V return. And what we can see from here is obviously we did get a pretty solid reaction, but then again, when we look, we didn't actually tap into the zone. And then we'll just look at these last few zones here. What we can see is we had this pivot supply. And if we just look at the way price returned back to the zone, it was a V return, because we're looking more specifically at the return, not so much the dismount away. And really when it comes to the dismount, we do want to see something more aggressive rather than something that's a little bit more corrective as well, because when we're looking at supply and demand zones, while we do want to see a corrective move in, we don't necessarily want to see a corrective move out, because what we are trying to do, again, with supply and demand is we're trying to identify areas on the chart or the footprints of where large orders are being placed in the markets that's causing a displacement in the market. And that's why moves or large moves are happening. And as a result, we're looking for price to return to these areas to rebalance those orders, essentially injecting the majority or the remainder of the positions that were created or entered on the first creation of that zone. Because essentially what we're trying to do with supply and demand is we're identifying a footprint of where large orders have been placed in the markets. We know that when institutions are entering large orders, generally speaking, they're not able to put their entire position size within their orders, so they're banking on price to return back to the zone in order to enter the remainder of their position, and that's where we're looking to target. But the only way for us to truly know if an institution or large collection of orders have been placed is by understanding and identifying the footprints that are left behind. Generally speaking, what that entails is seeing some sort of range or pivot created supplier demand zone that is being created. But the only way we're able to validate that zone being created is actually waiting for an impulsive move or an expansion outside of that pivot or range that was created. And then, like I had said, we're looking for how price returns to that zone. Generally speaking, we're looking for some sort of corrective nature back into it. We're looking for some sort of rounded move into it, but we're trying to be a little bit more cautious with something that's just pure momentum back into the zone in question. Now, on the flip side, with this idea in mind that we're looking for that expansive or explosive move from a zone being created, and that's what gives us our footprint that large orders have been placed. If we look at something like this that is very corrective, going down and then impulsive going up, generally speaking, what that would imply is that there's no real momentum that fueled this move. This would be the momentum that we're more or less interested in. So when we see that, that begins to give us a better idea of what's happening. But of course, the market isn't utopian, and it will do things that might not necessarily make sense on that particular time frame, and it's all about the higher time frame narrative as to what's happening. And as we can see, if we just zoom out that little bit, we were in a bull trend. We came down very corrective to a demand zone. We did get that initial reaction, but then as we can see what's happening in here, the flip between supply and demand is what's ultimately starting to push price to the downside. And we can see that when we start to look at supply zones that are being created on the way down, and also not holding any other demand zones that have been created as a result of the way price action has been delivering. So again, the best thing that you can do now that you understand the return to zone considerations and the probability that they have, and just looking at things through that lens, is to go to your charts, whether it be a blank chart or whether it's the examples that you've been able to prepare as a result of the first and second parts of the supply and demand zone series, and identify the returns back to the particular supply and demand zones and what they imply on the charts. We're going to build on this much further. These concepts of return to zone are going to be a lot more prevalent and understanding once we start to understand the reaction, the inner workings of supply and demand, and what one zone respecting or breaking another has with the overall larger picture. But first, it's a good idea to really ingrain the understanding of how price is returning back to particular zones and what that implies, as well as, again, understanding the larger impulses into the moves and what that often will provide to you as well. And again, I just want to stress that the market isn't utopian, and don't take some of this for gospel. Go ahead and test it for yourself and see if these sort of concepts are true to what you see, because there are some people who actually prefer trading V reversals, but they're a little bit more aggressive in how they do it. Again, there's different confluences you can add to it, and it comes to your testing and your comfort with them. And which is why it's so important to take these concepts to the charts and really dig into the price action. Because for me personally, when I'm looking at supply and demand zones and how price returns to them, I prefer the rounded returns and the corrective returns as opposed to the V returns. I've had more losses on aggressive V returns than I have on the corrective returns. But again, that also comes to your own testing, and it's important to really put the work in to understand how all these components come into play, because what you'll also start to begin to notice when you combine all of the three lessons into one is the zone creation, the different ways that you're mapping, whether it's range created or pivot created supply and demand, whether it's a continuation or a reversal pattern, will also play into the fact on how price is returning to these zones. Because like we said, this was a continuation pattern. We had a V reversal return, the zone didn't hold. We had a continuation pattern, we had a V reversal return, the zone didn't hold. Continuation pattern, V reversal return. The zone didn't hold. So we can see when we add on to the fact of continuation versus reversal models, we see a reversal model and we see a more corrective return back in, and we see the price get respected. Although in this case, when we look a little bit further, we have a continuation model, but we have a corrective return in, and we do get an initial reaction to it. But again, that's the importance of really understanding these concepts on a granular level. And that's why it's so important to initially put the work into understanding how to visualize the mapping techniques, whether it's range or pivot created supply and demand, then build on that understanding so that you understand the continuation versus the reversal models. Now it's important to apply how price is returning to how the zones are mapped and what the implications may imply, as well as whether they are reversal or continuation models, how price returns to them. And taking it a step further, if the reversal or continuation models are using a specific mapping technique, how is price returning to them, and how does price respect those particular elements? This is how you start to begin to build your trading models that you personally will use in various situations. You may have certain mapping criteria that you use in certain situations. You might only use pivot created supply and demand on continuations. You might only use range created supply and demand on reversals. You might use both, but then how price returns to each one of those dictates what you're looking for. You might look for more confirmation if you get a V reversal to a continuation model. You're looking for an additional entry confirmation that we'll get into in a later video portion. But again, just to get your mind thinking, but first it's important to now take what we've been able to apply here, these return to zone considerations, and apply them to your charts so that you can understand them and continue building on what we've built in episode 1, 2, and now 3. A few refinements that you can integrate into your supply and demand zones are the concept of inside bars, how we can view continuation patterns on higher timeframes and what they look like on lower timeframes, and finally, what wicks represent. These are all refinements that relate to lower timeframes, but you can use the higher timeframes to build upon them. And what I mean by that is if any one of these three situations arises on, say, a 1 hour chart, and you're not comfortable going down to a 15, 5, or 1 minute chart, you'll still be able to understand what is happening on these charts, which will allow you to still progress within your trading, but not need to go down to those lower timeframes in order to take those particular setups. So the first thing that we're going to look at is the concept of inside bars. And what is an inside bar exactly? An inside bar, quite simply, is a candle that rests within the previous candles. So in this example, we have a down candle or bearish candle. The next candle is a bullish candle. And what you can see is this bullish candle didn't break the high or the low of the bearish candle. It actually rests inside the bearish candle right here. And then what we can see is price then moves back to the downside quite rapidly. And if we just think about what this is implying on a lower time frame it back to our models of creation of supply and demand, what we can gain from that is that this is actually a continuation model of a supply zone being created, whether it be a pivot created supply zone continuation or a range bound supply zone continuation. And what this implies on that higher time frame is what this would be on a lower time frame. And again, what this allows us to do is if we see this type of price action on, say, a 1 hour chart, and we're not comfortable going any lower than that chart, we don't need to, because we understand that this inside bar is more than likely a range or pivot on a lower time frame. Generally speaking, what an inside bar is a range on a lower time frame. And what we understand about ranges are that they are an area of interest where price is held at fair value and multiple orders are changing hands, or on the flip side, low momentum. And the way we are able to discern whether it's low momentum or high momentum is what happens next. And in this case, we see a rapid move to the downside after the creation of that inside bar or range. And we can derive that this is then a supply zone that we would be interested in for price to return back into and look to trade. Now, on the flip side, the same can be said for a demand zone where we have a move to the upside, that creates a high, creates a low, and we have a bearish candle. It could also be a bullish candle. In this case, this could also be a bearish candle if we don't actually break this wick. The main thing about an inside bar is that we have one candle, the next candle stays within that candle, and then the next candle breaks it. And that becomes the most important part. Whether it's bearish or bullish isn't as important because of the concept that we understand happening. And this really is important when we understand the fractal nature of the markets and how something happens on a higher time frame and what it's doing on a lower time frame. So when we go back to the demand zone, what we can see is we have this inside bar, and then we have that rapid move to the upside. Again, this creates a demand zone, whether it be a pivot demand on a lower time frame, or, well, even conceptually, if we're just looking at this, if we get this move to the downside, a sharp move to the upside, and then a move to the downside, that's pivot created supply. Again, on a lower time frame, it could also be a range created supply. And as well on the demand zone, we get that sharp move to the downside followed by a move back to the upside, pivot created demand, or it could be on a lower time frame, a range, which is what an inside bar does imply as well. And again, what we're waiting for in both situations for price to return back to these areas and give us a reason for entry. Now, moving on, what we will see is, again, a refinement that we can use to understand the fractal nature of the markets. And in this case, what we have is price moving to the downside. We have a lower wick, an upper wick on the next candle, and then another move to the downside. And what this is conveying is basically this type of phenomenon, or even this type of phenomenon on a higher time frame. So what we can see is that this is actually potentially this on a higher time frame, and what we're seeing from a price action perspective is, again, a continuation model, that pivot supply being created, or even potentially on a lower time frame, a range being created that we can use as a supply zone. And on the flip side, we see that same thing being created on demand zones, where we have this bit of price action that either creates that pivot created demand or range created demand, depending on the fractal nature of the markets and how supply and demand is created. So again, what this allows us to do conceptually is we can use lower time frame refinements without actually going on to the lower time frames, whether it be utilizing the inside bar technique and understanding that that is a range on a lower time frame, or also just looking at the way candles interact and seeing a very quick pivot in the market. We can use that and understand that that is also a continuation pattern that is happening within the market that is either creating supply or demand zones. And then finally, the last refinement that we can use involves wicks, and more specifically large wicks that we see when zones are created. So in this first example, what we see is that price has a fairly large wick to the upside. We get that move to the upside and then a rapid move to the downside. We can say that a supply zone has been created, and again, we'd be waiting for price to return to that supply zone. Because this candle is relatively small with a large wick, we can map out the entire supply zone using both the candle body and the candle wick. And again, if we're looking at a continuation styled setup, this would be a pivot supply continuation, or this could even be a range created supply zone continuation, or again, it could be a pivot created reversal supply zone, or a pivot range bound created supply zone. So they work regardless of the zone being created, but what specifically is important is how we actually are drawing the zones. Again, like I said, the candle body and wick are relatively small, so you can use the entire zone. But if we get into a situation like this, where we have a very large wick on either the downside or the upside that creates a supply or demand zone, if I just unlock this and move this to the downside, what we can see is that ends up creating a very large supply zone. Yes, it is valid, but we're looking to refine our approach and understanding the fractal nature of the markets and what this wick implies. If we look at this wick on a lower time frame, what we can see conveyed in this little bubble here is essentially a supply zone being created. And that's what you will see inside of that wick on a lower time frame. You'll see the creation of that within this wick, whether that's a range created supply, because if we just look at what the price action is conveying in this candle, because we opened here, we moved down a little bit, we moved to the upside, we came all the way to the upside, and then we rapidly moved to the downside. The candle closed, the next candle comes up and then moves. If we just look at that bit of price action, what we can see, depending on the price action that leads to this is we just see a pivot created supply. If we were to look at something like this, there's your continuation model. Or what we can see is even just something like this, where we have that large range, and then we get even a more fractal range or pivot being created inside of that wick. But all is to say that what we're doing with drawing our supply zone, in this case within just the wick and not including the body, is simply a refinement using the understanding that what's happening on the lower time frame within this wick is simply a supply zone being created. But again, there's nothing wrong with using the entire candle for mapping out your supply zone. This is simply for refinements and just understanding the fractal nature of the markets. And again, the same is true for the demand zone, where within this large wick to the downside, if we were to look at that on a smaller time frame, what we would see is either a pivot created demand zone or a range created demand zone. More specifically, when we see these wicks, depending on how far down that you're looking on a time frame, say this is a 1 hour. If you look on the 1 minute, generally speaking, you probably will see some sort of range. But if you're looking at a 15 minute, generally speaking, you're probably going to see more of a pivot created supply or demand zone being created within this wick. So something to keep in mind. But again, these are all just simple refinements that you can use to understand the fractal nature of the market and how supply and demand relates to these concepts, which will make your trading a little bit easier, especially early on when you're maybe not as comfortable going to the lower time frames. This shows you that you don't necessarily need to go down to those lower time frames, because you understand what's happening conceptually on the lower time frame without actually going onto the lower time frames, and the power that this is granting you if you're able to use these concepts correctly and understand them properly. Understanding the fractal nature of any market, how a higher time frame and lower time frames, what they do to work together or work against each other, and understand the framework or the footprint that we're looking for. It'll make your trading so much more easy to understand and navigate through if you can look at this and go, I know what's happening on a lower time frame. I'm not comfortable trading on that lower time frame, but I understand what's happening, so I know that I can use this concept to build up trade ideas. Because I think it goes without saying, there are many times when we rush to go down to a lower time frame and we get lost in some of the noise, or what seems to be noise. Whereas if we stayed in a higher time frame and just seen this sort of phenomenon happening conceptually and understood what was happening on that lower time frame, it would make our lives so much easier. It would make our trades that much easier, and we would be left with higher probability trade ideas that don't involve too much afterthought or don't involve you second guessing if that trade should or should not be taken. Again, we combine these with how price returns to these zones, whether we get the rounded return, whether we get the corrective return, or if we get the V return. They'll all factor into how we look to trade these zones. But again, these are fractal refinements that we can use to understand supply and demand zones that are on the higher time frames but are actually built on the lower time frames.